Hello, everybody. Welcome to Friday. The S&P 500 was up 0.14% today. We're not having a show today, so I thought I'd just do a quick summary of what I saw happening this week. It was another positive week. We've had 8 positive weeks in a row. Last time that happened was 5 years ago. Continues to go on. The week between Christmas and the first couple of days of the year is generally good. 79% of the time it's up. So hopefully that'll portray a little bit further upward and maybe even get us into the new all-time high. We're very close to that as it stands. Today's good news really, I think, is the overall year's good news, which is just that inflation and the rate of growth of inflation continues to come down. And so the PCE index, which is the measure that the Fed likes when they're talking about inflation, when they talk about getting to 2%, they're talking about core PCE. So today, core PCE was down to 3.2%. It was at 3.5% last month. And that's versus last year, same month for November in this case. But if you look at it month by month and you look at the last 6 months in a row and you add all those up and you say multiply it times 2, if we just keep going the way we have been going the last 6 months, for the next 6 months, our inflation actually will come in at 1.87%, which is below the 2% target, which is why we're hearing the Fed talk about, not raising rates, and why the market is talking about the Fed lowering rates next year. Because one of the things that can happen is you can actually start to have deflation, which as a consumer, we all like deflation, when things start to get cheaper. Because right now we're having slower inflation, which just means they're still getting more expensive, just not quite as quickly. But deflation is quite hard on companies and very difficult for the economy. Matter of fact, I'd say the Federal Reserve is more nervous about deflation than they are inflation. So you can have a recession that causes the Federal Reserve to, pull back on the rates and start to lower rates again. You can have a situation where there's just deflation that happens, somewhat related to a recession, but not always. And so the bet right now is the Federal Reserve will be lowering rates in March, which is kind of amazing. It's actually at 87% is what the futures market's saying right now, probability that the Fed will lower rates by a quarter point in March. It was at 27% just a month ago. So as these numbers come in showing inflation, doing well, showing the job market still, doing well, there's some room for, the Fed to maybe lower rates. Now, the Fed, as they've come out and spoke in different interviews and what have you, has said there's almost no way they see that they'll be lowering rates in March. But the market keeps upping the bet on the March decrease, which is kind of interesting. The market's also now expecting a 1.5% a decrease in total rates, so roughly around 5.5%. So we go back down to 4. That's a 3.75 to 4. They use a little range. Would be the rate if the market was right. The Fed put out their dot plot, at the end of the last meeting, projecting what they saw rates being for 2024, and that was 0.75 of a point lower. So, that's going to be the big argument. The market's getting ahead of itself. The Fed's going to say that they're, not going to lower rates that quickly, that kind of thing. So, irregardless, they're both talking about the same thing, which is rates coming down. The stock market loves when the rates stop going up, and it really often does very well when rates come down, unless there's just a really hard recession as far as that goes. And at the moment, we are lining up still all year long for this soft landing. And it's been kind of an amazing thing to watch altogether. So market's in a very good position. We're seeing, a continued growth. We had that one, down day this week. That we've basically kind of been crawling back up towards to get that back, and really just an incredible strength altogether that is just pretty impressive to watch. This is not a normal market in the sense that we've had this huge rate increase, and now that pressure's coming off, and people are starting to pile back in, and we're seeing fairly high flows. It is the holiday time period, so flows are definitely lower. But prior to this week, the volume was actually pretty decent. We're seeing, near record flows coming into some of these ETFs, like the Spider ETF is State Street makes a group of ETFs called Spiders, and there's one that replicates the S&P 500, has ticker symbol SPY. Had a couple days here over the last couple weeks that are the highest in its history in terms of inflows. And so that's really a good sign. Actually, people are starting to pour back into the market. There are trillions of dollars sitting in money markets and banks and CDs. Again, everybody was very excited about a 5% CD and still should be. But if the market is going to do what it's doing now, you're going to see people start to take some of that money off of the banking system table, so to speak, and get that back into the market. It is a competitive environment. So if you feel like you can make 11% in the market, which is the average long term, you're going to be, excited about that possibly and look at some of the money you have sitting outside the market and start putting that in there. And of course, the professionals are in the same boat. They're competing against these indexes and what have you, trying to outperform them like we do. So that really makes you want to be in there. Sitting on the sidelines right now could be quite disastrous for professional investors. So I think that's why we're seeing such strength and buying on the little dips that come up and what have you. So anyway, really good week, really good year, actually, just a fantastic year in the end. Pretty volatile. We had some big drops in here. We had a big 10% drop from the end of July to the end of October. There are periods where you're kind of wondering what was going to happen, but we stuck with this throughout this time frame because we've been in a primary uptrend, and we're still very much so in a primary uptrend. The bond market has been participating to the upside very significantly, really since the end of October. As a matter of fact, you could make an argument that the bond market is doing better than the stock market, at least since that time frame. Bond market has a long ways to go to get back to the high places that it was before, and it might not do that for quite some time. But just to see some of the gains coming from that arena is really good. It just means that if you've got a 60% stock portfolio and 40% bond portfolio, both sides are now performing. Unfortunately, in 2022, it was just the opposite, but 2023 is kind of making that back. So it's kind of nice. So anyway, that's what happened this week. Really enjoy watching all of this. Enjoy doing these videos. Want to thank everybody so much, for watching all these videos and commenting and continuing to, let me know, what they want to know about. Again, we won't have a show today or next Friday. I'll still do these daily videos, starting Tuesday after Christmas. Through Friday, and then I'll have a couple days off the first, second, and third of January. I won't do videos then, but nonetheless, look forward to seeing you next week, and have a great holidays and enjoy your time. Thank you.